Michael, thank you so much for coming.
Happy to be here.
I'm excited. I just want to jump right into it. So you launched Harvest almost 2 decades ago, and it was right in the middle of the financial crisis. So my first question is, what made you crazy enough to dive headfirst into something like that? Like, I'd love to know.
Yeah, well, you're right. I mean, the financial crisis was a very difficult time, and when you're in the middle of the forest, right? You don't really know when it's going to end. So by 2009, we were getting to the later stages of it, but you didn't know. There was a lot of issues still. There was a lot of banks in the U.S. had problems. So I had always had this idea of launching and starting an investment company, and to use John Lennon's line, "No friends, but yet no enemies." At that point, when you're launching a company, at the markets were at that point, we didn't have any performance to talk about, but we didn't have any bad performance. So it was a good opportunity to sort of go out there, take an investment philosophy that I believed in, which is really about long-term capital growth, and bring it to the market. So it was very fundamental. And I felt at that point in time, there was a lot of people that were confused about what had happened in the markets, and just seemed like a good opportunity to launch a company.
So take me back there. So when you were in that, because I know that Canada actually has and had a very good infrastructure. So I don't think we got as rocked as the United States.
Right.
So we could put that to regulation, things like that. But even in the industry, like dealing with that and coming out of that, like why do you think Harvest worked at that time? Do you think it was a very specific point in time when you guys were coming out of that and you were going into the growth, or what was it about like this environment that really made it like helped you harvest?
Yeah, right. Well, you're right. Canada did not get as hit as hard as the United States, but still a lot of our stocks were down. And at that time you could get 9% on BMO, and I think at one point 11% on CIBC. I mean, the rates, the dividends you could pick up were incredible. But getting back to the business, I had about 25 years of experience at that time, had a lot of contacts, had been in the industry my whole career. So like any business, it's your first few years are the toughest. You've got to get people's confidence. They have to believe in what you're doing. And, so I sort of went out on the road and just started talking to people and talking about the philosophy that I had and how I wanted to bring it to the marketplace. And when you get really deep into a cycle, like we had sort of at that point in time before the financial crisis, people start going up on the risk scale to get better returns.
Right.
And, the idea was let's boil it right back down to the fundamentals. Let's buy great companies. Let's buy companies that have great management and that can grow over time and are proving themselves in that current environment that they are continuing to grow. And let's put together portfolios of these types of businesses. So it's I think the hardest part is like any business going out and convincing people, like convincing in this case advisors, because that was the majority of the market at the time, to take a look at our products. And we went out there and launched our first product by October. Actually, we are October.
Yeah. Okay. Cool.
So 16 years ago.
Wow.
And raised about $25 million in the product, which was our Harvest Banks and Buildings Income Fund, which doesn't exist today.
Fair.
But the idea was you can get these great high rates in the banks. You had a lot of real estate companies that were paying out huge amounts of income as well. So we combined a fund that had hard assets and financial assets and took it to the marketplace.
So did that insight come from your career? And was it, one of those things where you're thinking to yourself, like, this is a structural wave and like, I want to be on this wave because it's coming, so I want to get ahead of it? Or was it, hey, there's a gap in the marketplace, nobody's doing something like this, or if they're doing it, they're not doing it at a high level? Like, was it more like, this is where the market's going and this is where the, every sort of things are going? Or is it, hey, like, nobody's doing this, we should do this?
Well, a little bit of both. I mean, I wasn't really thinking too much of the structural side at the time because we started off as a closed-end fund company, which are structured products. But it was really just taking that fundamental philosophy and applying it to those products and growing forward. Even though today we're an ETF company for the most part, like 90% of our business, but it's the same underlying philosophy that we're following. So the idea was, let's just get back to fundamentals.
Right.
People had been beaten up badly. People didn't really know where the market was going. And let's just take a fundamental idea to them and just see if we can get this spark going. And it did, and it worked, obviously.
That makes sense. I think it is interesting how so much innovation, like financial innovation, came out of that, right? Yeah. Whether it was regulation or whether it was new products or whether it was stuff that, I don't know. I think the financial engineering that happens these days, it's It's incredible. It's honestly
Yeah.
astonishing. Did you guys feel early on that you were ahead of the curve in that manner? Or was it sort of like, hey, like I said, like this is something that a lot of Canadians need to harvest and create a sort of income source for themselves? Or was it like you guys, had an engineering team,
Yeah.
great financial engineers and stuff like that?
Well, in those days, I mean, we, excuse me, we weren't in the option market. We hadn't gone there yet because the yields were so high in the stock market because of the financial crisis. So it was really just a matter of taking that philosophy, not trying to do anything special, like no financial engineering, but to take that philosophy and that long-term approach to the markets and bring it out to, at that time, mainly advisors. And we were very small. Actually, at that time, we farmed out the investment management to outside investment managers. We didn't actually bring the team in-house until a couple of years later.
Okay.
But again, I had to actually go out and find managers as well and say, look, this is what I want to do.
Convince
Here's the type of
basically,
philosophy. And they're like, well, that's pretty simple, pretty basic. I'm like, yeah, but simple and basic works.
Right.
Like we get too far up that scale sometimes and get too complicated. Let's just bring it back to the fundamentals and take that to the marketplace. And it's, over time it did work.
So skipping forward a little bit, but in today's environment, a lot of investors are looking for, 8 to 10% and things like that. I guess, what are your thoughts around that? Do you think a lot of investors are too comfortable with that? And if, the market changes, I guess expectations, like where do you think expectations maybe should be, where they are, and how do you guys sort of message that to some of your investors?
Well, I wish they only wanted 8 to 9%, because that's really when we launched. Going back to your other question, we were paying out a 7-8% rate, which was very high at the time, and that was sort of a bit of a wake up call to some advisors. So we were one of the first to bring out higher yields.
Yeah.
Now the expectations are double digits.
Yeah. Well, I guess with some of the NVIDIA and stuff like that, certainly.
We've launched single stocks, as you know, they've done extremely well.
Yeah.
The expectations on those are much higher from the standpoint of yield. But if I could step back, I think that that has a lot to do with investors today. If I think back even 15, 16 years ago and through my career, people really focused on market. So your stock market returns. What's your 1 year, your 3 year, your 5 year, your 10 year? A lot of advisors won't even talk to you until you get to a 3 or 5 year track record.
It's too new.
Yeah. What's changed now is people are looking at more of a total return structure. So I want to get some growth, but what kind of yield can you generate? What kind of performance is that going to derive for me over the year on a total return basis? So that's a big change that we've seen really since around the time of COVID. So that's something that we've embraced. We've got a lot more aggressive on that side. And on top of that, when bringing options into our strategy, back in 2013, that also helped us enhance those types of returns by using the option market, by selling call options.
Yeah, speaking back to 2020, I remember obviously interest rates were on the floor and it was very, you couldn't really get great stuff with bonds, and people were just looking for yield. So a lot of people would be in like dividend stocks and things like that. Did you guys experience like a huge source of growth from that period because people were looking for yield before central banks like increased rates?
Well, you're right. I mean, rates had been going down for about 25 years. And, my career, I benefited from that because as rates went down, stocks went up. And there's an old line that, interest rates are like gravity on stock markets. So as rates have popped up, stock markets came down a few years ago. But now during that time, you had interest rates dropping, stock markets were rising. So I think part of our philosophy at that time as well is, well, how are you going to grow your capital? And we're looking really at the retirement market and generate a yield. Because if you simply retire and put your money into other investments or the stock market, you're only going to get a 2 or 3% yield. If you put it into a bank account or into a GIC or whatever it is at that time, again, you're going to get about at one point 1% or no yield.
Yeah.
So
absolutely,
it was a great solution to help people grow their capital, because if you're retiring and you're possibly going to be retired for 30 years, how do you keep that capital over time and generate cash flow to live on? So that more and more was boiling down to our philosophy as a company about how do we grow capital? Well, we own great companies. And then how do we generate income? And as stock market started to rise and those dividends rates started to drop, we embraced the option market and started to develop an option strategy to generate that additional income.
Yeah. So I think with this strategy, and I think this is probably what I'm most excited to ask you about. So obviously there's, um, it sounds fantastic, and it is. You know, you would have critics that would point out things
Mhm.
around, you know, in a booming market, it limits upside, and then it only works in certain markets and things like that. So what do some critics of maybe some of your products have right, and what are some things that they don't have right at all?
Well, they're absolutely right from the standpoint of if you write options, you will limit your upside,
Mhm.
especially in a very strong market. So it really comes down to the balance. How much do you write or sell calls? How much do you sell to create enough balance that you've still got the growth of capital, but you've also got higher cash flow? So we find that number to be around 60 to 65%.
Mhm.
Sorry, unwritten. So your written part is 30 to 35%. Sometimes we go a little bit higher. Sometimes we've been down in the mid 20s. But the idea is we want to have as much long bias
Right.
exposure to the underlying market. So if we're writing less to enhance the income, but we've got 60 or 65% tied to the stock market, we're going to get the growth.
Mhm.
So they're absolutely right when they say, well, you know, if you own a stock naked, so to speak,
Yeah.
it's going to rally.
Right.
You're going to capture 100% of that growth. If you're selling some calls on it and you're monetizing a bit of that income or monetizing some of that growth to generate cash flow, you're not also going to get, you're not going to get the full 100% upside,
Mhm.
but you're still going to get a very nice return.
Absolutely.
And option writing, even though when markets drop, stocks drop, even stocks that have options written on them will
Yeah,
drop.
yeah.
But the income helps to offset. Sometimes when you're sitting and waiting, you could be waiting 3, 6, 9 months for markets to recover. That income will help maintain that sort of position in that investment.
Yeah. Okay. That makes a
Yeah.
lot of sense. And I think, like most things, obviously, there's way more nuance than they're good, they're bad, they're
Yeah.
evil, they're this.
You know, and we just did a piece on options, and the whole point is options have been around a long time. They're very big, deep markets, like in the $400 or $500 billion range in the United States. Hundreds of millions of these things trade daily. I mean, it's a big market, so it's not evil.
Yeah.
You know?
Yeah.
It's
Yeah.
they're not all bad.
Yeah. Totally.
I think if you're in a growth market and you're writing calls on 100% of a portfolio, you're gonna basically lose a lot of the upside,
Right.
and you will erode your capital.
Right. So it's how you structure it, like
Yeah.
you said, with okay.
Yeah. So if you've
70,
got
30.
30% or 35% written, so you're generating that extra income, and it can be a very attractive income, and you still got some upside on that stock. So that's part of the whole strategy. And it just takes time. There's some theory to it, but a lot of it's just the practical, and you have to sort of build that up over decades in the business. You sort of
Absolutely.
figure out how to do this.
And like what's
Right.
the sort of Goldilocks range for you guys and things like
Yeah,
that. Yeah.
exactly.
So I want to go back to interest rates. So I guess, you know, everybody feels like, you know, I guess that first big rate cut is coming, or
Yeah.
and people are sort of banking on it. How are you guys thinking about the next couple of years in terms of the market sort of shifting, rates being a bit lower, a lot of maybe good inflation, maybe frothiness, things like that. How do you guys see that shaping out?
Well, we have seen one cut already in the States. We're expected probably to see another one, maybe 2 this year. We think there's going to be 2 or 3 probably over the next 12 months. So that will help markets. And I think we're seeing, here we are in October 2025. So we're seeing a very strong market. It's seasonally doing much better than it usually does
Absolutely.
in September, October.
Yeah.
I think a lot of that has to do with earnings continue to come in at a pretty good clip. Objectives are being met by these companies. And there's the thought that interest rates are going to start finally declining. If that occurs, then that's fuel for stock markets.
Yeah.
So this is all sort of playing into it.